Okay, we are live reacting to earnings. My name is Travis Hoium. I have the channel, the RIVE Project at RIIV on YouTube if you're interested in looking at the content that I'm putting out there. And I get to talk stocks today with Jason Hall, the creator of The Smattering.
Hey, buddy.
How are you doing, Jason?
I'm good. This is our third day doing this, and I'm having a ton of fun. And there's one of the for me one of the companies I have anticipated the most this earnings season. Redfin reported. We're going to talk about that. We've got we're going to talk about a couple of EV stocks, right? We're going to talk about Rivian. We're also going to talk about Lucid too, that reported
Yep, we missed that one
yesterday.
yesterday. Yep.
Yep. So we're going to talk about those two, catch up for some people that wanted to hear. Unity, which is just a really interesting platform for creatives building all kinds of different content, and something that's right in your wheelhouse. We're going to talk about Wynn too, right?
Yeah, we were there not too long ago, so
Yes, we were.
excited to see what their numbers look like. Unfortunately, we will not be covering FTX and Binance today. So
No. We'll
anybody,
leave that to other people to talk about that. All right, we're gonna go ahead, Travis. Go
yeah,
ahead.
why don't we start with Redfin? What's the background here? What are we looking for from Redfin? Because they got a lot of pieces of the business that kind of pull together in their housing related business. But what are we looking for?
So I haven't looked at the stock after hours. One of the things that we've tried to do with these, Travis, is to go into these with as clean of a slate and as limited amount of bias to what other people are saying as we can, so we can try and give a relatively authentic reaction. But I'm going to admit, I did, when I was searching for Redfin to find the website to get the release, I hit enter too soon and I saw the news. So I do know that they have announced that they're folding Redfin Now. This is important to talk about first because Redfin Now is Redfin's iBuying business. If we go back about a year ago, a little more than a year ago,
Yep.
iBuying was all the rage, right? You had Zillow that had made a major pivot and was making, like, they had a few years before that, they had made iBuying like their kind of their cornerstone for their next phase of growth. Redfin had started doing it. Open Door, other companies had gotten into basically the house flipping business, essentially, is what it is. Redfin just said they're getting out after. I mean, they basically, when Zillow got out, it's like, okay, time for the pros to show everybody how to do it.
I
And
think that
now
was what a
they're
lot of people
exiting,
thought. Yep.
right? So now they're exiting that business as well. Again, I haven't seen what the stock is doing in after hours, but I can tell you before today, and I bought some Redfin last week because I believe the company's going to get through this downturn and it's going to be fine. And there's a tremendous upside. But I think there's a good chance that stock is probably getting killed based on that announcement. Or
Mhm.
maybe the market's going to love it. We'll figure that part out later. Let's talk about the numbers. I'm going to share some slides, and we're going to start right at the top here. So give me a second to pull up the highlights from the quarter. So a couple things. So real estate services revenue came in at $212 million. You got to remember Redfin's biggest business, their most important business, they're an online brokerage, right? They have agents. They have a differentiated model. They charge lower commissions. They pay their agents a little bit different. And so that's a really important part of their business. And came in ahead of guidance, the company guidance, right? $212 million in revenue. So that's positive. Another thing, market share is up a very small amount. But again, I think that's a real positive. I've wanted to see from Redfin for a long time, taking more market share. So they're showing that. They're kind of backing into it right now, Travis, because activity in existing home sales has slowed substantially. More traffic on their website. That's good. They're putting more agents in more places. Again, that's good. That's that expanding listing coverage. Mortgage attach rates. That's good, but there's also some risk here, Travis, because if they're starting to hold, if you look, we'll get to their balance sheet in a little bit. They're holding a lot more mortgages on their balance sheet now than they did at the beginning of the year. And there's a certain level of risk attached to that we'll talk about later. But they're growing other things too, like their rentals business. And as we're going through a housing downturn, a housing sales downturn, listing rentals and generating rentals income could be, I mean, it could be a positive way to continue to grow. So they continue to try to differentiate. They continue to make some some progress. So I think it's important too, if you look at the revenue cadence. So revenue was higher than it was in the year-over-year quarter, but it's basically back to like 2018 levels plus a little bit, right? And especially when you look at that properties business right here, that's the part that's going away. You know, they're basically back here. You know, they're back to 2018 levels in terms of the size, of the business. So that's some important stuff to talk about. I'm just going to move through a couple of charts here, and I want to get to operating expenses because this number started to come down. This is a cash flows business. I've done some other videos talking about it, Travis, and they've been burning cash this year, right? As they've tried to leverage up and scale up. And it's really good to see that those operating expenses are coming down. So they announced they're folding Redfin now. There's hundreds and hundreds of people that Redfin is going to be letting go as part of that. So
Yep.
what we don't know is how much of that is going to affect future guidance. Here's the outlook right here. So again, this is for the fourth quarter. I don't think, they didn't give us a guidance for 2023. But let's talk about the end of the year, kind of go through this. First of all, Travis, there's nothing here that surprises me. Okay. This big revenue decline because they had quickly accelerated and built up this iBuying business. They're folding it. It's not a surprise.
And by the way, the revenue that comes from that business, because you buy the home and then you sell the home, so you don't take, your 7% commission as revenue. You take the entire value of the house as revenue. So
right.
That's why a massive decline in revenue at a Zillow, at a Redfin is not that surprising when they get out of the iBuying business, because what you want to look at is how much money were they actually making, and the answer was none.
That's the thing. The idea was at scale that this would be large revenue. Using leverage, you can get really good return on your actual cash investment by using leverage at relatively low actual margins, because again, it's a house. So again, that this business is shrinking. There's no inventory. It's a tough spot in the market. They are saying we're going to grow that rentals revenue. And again, this is a kind of it's terrible to say, but it's the reality, is that in weak economic conditions, the rentals business can be a little bit better than the selling of homes business, because people still need somewhere to live, right? So the mortgage business, again, they're still expected to lose money here. There's a little bit of balance sheet risk we're going to talk about there. And there's some intercompany eliminations that are going to kind of affect the bottom line a little bit too. Going to continue to lose money, right? We know that that's going to continue to be kind of the reality right now. Travis, any thoughts while I get over and start getting ready to share the balance sheet information?
No, I think the question that I have in this space generally is, what do we do as investors? Because I think the housing market is going to go, we have been in 40 years of structural interest rate declines. And now what happens? I mean, interest rates are up, have almost doubled in the last year or so?
I think you'd say more than doubled.
And they're, so that means that
and they're on track to continue to increase based on what Jerome Powell's saying.
Yes. So now you're talking about buying the same home. If you're gonna buy a home with the same monthly payment, now that home is suddenly worth, just based on the math, 30-40% less. Now that doesn't happen that way in the housing market, because people can just decide not to move. I mean, I have a 2.8% interest rate. I'm not moving anywhere anytime soon. So I think there are a lot of people like me.
Same. Yeah.
And it slows everything down. And if you're Redfin, what you're in the business of is transactions. It's not just
the other part of it too, Travis. We talked about the margin profile of that business. It's big revenue dollars. Low margins can make big profit dollars, especially if you're using debt to get a little bit of leverage benefit. The risk there is it's like being in the steel industry or one of these other high fixed cost industries. When the demand cycle turns and the value of the product you're producing falls, and you've built these high fixed costs, like if you have a ton of houses on your balance sheet that you paid a price for, if the market freezes up and prices fall just a little bit, and you're still servicing debt that you've taken on for leverage to buy those properties, a nice little profitable business can get ugly and unprofitable really quickly. In the press release, Glenn Kelman, who I will tell you right now, he's one of the CEOs I admire the most. He really is. He said, laying off 862 colleagues and friends is heartbreaking, but I feel relief about closing Redfin now with relatively low losses, right? So it's obvious this is a management team that sees the cycle turning and realizes we have to make a decision right now. Look at our balance sheet, look at our working capital, and this is something that we cannot put off. He goes on a little further and says, we're profoundly grateful for the dazzling entrepreneurs who built that business on a knife's edge, right? And that's the thing. The balancing act is so challenging here. I'm not surprised this is how it caught me off guard a little bit, but thinking about it, I'm not surprised that Redfin's doing this because they have enough other businesses that can be profitable and don't
Right.
need to be leveraged, right,
It's
Travis?
it's the exact same decision that Zillow made a year ago.
Yeah.
Is the way that I look at it. I mean, Zillow was taking a much bigger swing
Oh,
at
yeah.
iBuying than Redfin was, but they went through the same analysis and went, "Oh my gosh, when we have this much leverage on the balance sheet, when our hopeful margin is, 3-4% on a $500,000 home, if the market falls out and we've got $10 billion worth of inventory and now we're suddenly in the red on all of that inventory and now we have to unload it and everybody, in the market freeze. I mean, if Zillow wouldn't kept going with the iBuying business, they would have been in real trouble today. And that's, I think, something that all these companies are coming to terms with. What I wonder though, and this will take a little bit longer to process, is does this leave an opening for smaller, more nimble companies like Open Door, OfferPad, I think is the other one,
Mm-hmm.
to just say, hey, this is what we're going to do. This is the niche that we're going to serve. We're not for everybody. We're not trying to buy every home, but we know what we can do well. And, I haven't dug into that business in a while, but, a year ago, Zillow was doing, let's say, margins of 8% and OfferPad was doing like 15% because their businesses were just fundamentally different. They were doing more rehab and things like that. So that could be really interesting because there is, I think, a case for, hey, I want to sell my home and I want to sell it right now. And I don't want to deal with 50 showings and having to clean the house every day and all of the hassle that goes with selling a house.
Yep. Yep.
And,
Well, and let's face it. Let's face it, Travis. What we've seen over the past couple of years is an abnormal market, right? Where there was such tiny demand and massive, or such tiny supply and massive demand. You didn't really have to do much of anything, and you could get a premium price and multiple offers above what your listing was and sell it quickly on your terms. That's probably not going to be the case going forward because it's really never the case for an extended period of time in the housing market. In a normal cycle, you have to do work on your house, you have to paint things, you have to fix it up, and it takes months, right? And there's real negotiations where there's give and take, right? Not you just standing there with your hand out waiting till somebody puts the amount you want in it and then somebody else goes and puts 10% more, right? So that's the reality. I'll tell you this though, OfferPad and open doors stocks, I mean, they're penny stocks at this point, right? So the market doesn't believe they can do it. The challenge, and this is the thing that I've said this publicly a lot of times. I've never been a big believer in the iBuying business at scale because when it comes to real estate, and that is such a transactional business. You're not buying real estate and owning it for the income it generates as a rental property, right? You're flipping it. You need so much expertise. You need to understand the market you're operating in. You need to have skilled tradesmen that you can call and they can be there the next day. Right. All of and building out that infrastructure in a highly cyclical industry like single family residential housing is difficult to do in one town, right? And to try to do that in, a couple of dozen states.
And then there's like micro segments inside of a town.
Oh yeah. Yeah, absolutely. I mean, that's the bottom line. Everybody knows, right? You have different economic strata in the same town, like you're talking about. You have these micro environments. So I think this is the right decision for Redfin to make. I'm not going to look at the stock price because, like I said, I bought last week and I don't want to know. Let's talk about the balance sheet here, Travis. I think this is really important, and I know we're going to need to get moving on to some of these others, but I think this is really important because if you're a Redfin shareholder right now, or you're interested in owning this company, the reality is that there's probably going to be a lot of living off of working capital in the near term. Because if you look at the statement of comprehensive loss, so this line right here, a loss from operations, the operating loss, $245 million, the first 9 months of the year, substantial operating loss in the quarter. And the numbers are going to get probably, I guess, exacerbated is a way to think about it, because now with these layoffs in the fourth quarter, there's probably going to be a lot of severance expense.
Yeah, I think the guidance was for a pretty significant loss and an EBITDA loss as well.
Yeah, right. And so that's the reality. So that's happening at the same time that your primary business, the number of houses being sold and the income you're going to generate from commissions is falling. But here's the 9 months ended operating cash burn so far this year, $149 million. So that's coming down, right? That is coming down compared to the year ago period when they were burning a ton of operating cash trying to get to scale in that iBuying business. Now let's look at the balance sheet, because again, there's the fact that you're burning operating cash. What do you have? So roughly 1.2 billion in current assets. That's either cash or things that you can convert to cash relatively quickly, compared to current liabilities of $645 million. So that's well over 600 million. Well, a little bit less, excuse me. That's a little bit less than $600 million in working capital. That's a pretty sizable margin of safety, Travis, I think, for a company like Redfin going through this downside of the cycle. Here's one risk. We mentioned this, that the fact that that mortgage attach rate that they talked about, went from, $36 million in loans held for sale at the beginning of the quarter. Now it's $256 million. The thing that I don't know, and I'd need to look at their cadence of their quarterly reports to see how this number's changed over recent quarters, are these mortgages that were wrote at substantially lower rates than mortgages being written at today? Because if rates continue to move up, that's going to drive down the value of loans on its balance sheet. And if the company determines for the company, and then it's holding them for sale, right? The plan is to sell them, but if the market could drive down the value of that. So that's the book value. What it may have to sell them for less than that, right? So there's a bit of a risk there.
Question for you, and sorry if you touched on this, but isn't one of the differences in their business model versus competitors that they're primarily compensating their employees with salary as opposed to based on commission?
That's
so doesn't
true.
that give you operating leverage in good times and operating leverage in bad times, which when revenue is declining can be bad for margins in the bottom line?
Yeah. So their sales staff, this is important, right? So they have this model where they charge a lower commission to sellers, right? And then like you said, they pay a salary to their sales staff. And the typical model for a real estate agent is 100% commission, right? And they have to pay desk fees to their broker they work for, right? So you're actually paying somebody to use that office.
This is why Buffett loves the business. He owns the local real estate place here. Yeah.
Right. So it's a good business, right? So needless to say, it benefits the brokers because their costs are exactly related to properties being sold, right? And if a property is not being sold, they're fine. It doesn't affect them. And that's a challenge, could be a challenge for Redfin. The other part of the conversation, though, is that Redfin's agents on a per agent basis sell more homes, right? So
they're more productive. More
productive.
The business model works. I'm just trying to point out that there could be a downside in a downturn where
it's going to be, again, that's back to that steelmaker, Travis, back to that steelmaker comparison of fixed costs. When you pay your salespeople a salary, you have a higher fixed cost, right? And the reality is, if volume falls substantially, the decision they're going to have to make is, like, the employees that are part of Redfin now that they're getting rid of because they're closing that business, you're going to have to start laying off agents. That'll save you money, Travis, but the risk there is when the market does turn, Redfin needs to be in a position to quickly take advantage of that turn. And if you cut your staffing back too much,
yeah, it's going to be a
you
balance.
can't list the properties that people are coming to you to list. So there's a real balancing act right there. But I'll tell you, Travis, I have faith in Glenn Kelman. I think he's a great leader. I think he's really thoughtful about these things, and I have faith. He's been through these cycles before, so I think Redfin's going to be fine. There's still risk. There's obviously risk if you look at the fact that the stock is down 96 or 97% from the high. But I think this is like one of those opportunities to buy a stock that is so beaten down, the market has basically left it for dead, that I think is going to emerge from this in a few years fine. And 10 years from now could be 20 or 30 bagger stock. I think that's a real possible outcome here, and maybe a lot higher probability than people think.
All right. Well, I'm going to have to come back to this one and sort of rethink this market, but appreciate your thoughts on Redfin's earnings. Let's move over to the electric vehicle space. This week is the big week for the non-Tesla companies. I wanted to touch base on Lucid, which we thought we were going to get to yesterday, but ran out of time. The big number, the challenge with Lucid and a company like Rivian, which we'll talk about in a second, is they're not mature companies. So we're not judging these companies on their net income or their cash flow. Really, the two things I'm looking at are what do reservations look like? So how many people are standing in line, and how long is that line getting, or short is it getting? And what does your production look like? Because you want to have production growing, and you want to have more and more people demanding the vehicle that you're making. So if either of those things break, that's where companies are going to get into real trouble. We won't get into modeling out when they're going to get to cash flow positive and stuff like that, because I think we're years away from that for both of these companies. Lucid, the challenge, and the stock was down today, is they said their annual production guidance is going to be 67,000. I don't think that was a surprise. What was a surprise was 34,000 reservation holders, which I believe was down from 37,000 a quarter ago.
That number's going the wrong way, right, Travis?
Numbers going the wrong way. That's a 10% decline in one quarter. That's a big drop, and we'll see.
Well, what are your thoughts about why that's happening? I know you have some thoughts.
Well, yeah, I have a lot of thoughts. I mean, I am a reservation holder for a Rivian R1S, and my reservation just got pushed out to at least 2024 at the very earliest. And the challenge for me is, well, like, we need a vehicle. We're a growing family. We need, the appeal of the R1S was it's a 7-seat electric SUV. There are no other real 7-seat electric SUVs that cost less than like $120,000. I think the Tesla model, is it Y or X, is
the Model X, right?
The Model X is like 120 grand at this point, and it's not the same size as a real SUV.
It's more of a crossover. It's not the full SUV with the space that you would get.
So that was the appeal for us. So that's the reason that we were a reservation holder. Well, you push us back, and I was expecting to get a vehicle within the next, let's say, 3 to 6 months. Now we got to make a decision as a family. And there's probably, I assume there's a lot of people in that position. Now, maybe a bunch of the reservation holders for a Lucid can wait and don't really care if they get it this month or next year or the year after. They're just going to sit there and because they want the vehicle. I think that's going to be a strange balance. The other thing to throw into that is, as we go into either maybe we're in a recession or going into a recession, interest rates are rising. The idea of buying a $70,000, $80,000, $120,000 electric vehicle becomes a lot less appealing. So do we see demand for these vehicles fall simply because buyers can't afford or don't want to spend the money on vehicles like this? It's an open-ended question right now. And the fact that their reservation holders, the number of reservations is falling, I think is not a great sign. This is not a stock I've ever owned, so I don't have strong feelings one way or the other. But it's one of these where. What are your strong feelings, Jason?
I do. Before we get to those, I want to point out, talking about recession, inflation, all those things. You know, to get your place in line, that's $1,000, right?
Yep. With the
And
Rivian is, yeah.
there's and it's refundable, which is as it should be, right? I wonder if some of that impact isn't people that are like yourself that are gone from, hey, you're going to get it early next year to you might get it late the year after, and they're like, I could use that $1,000 for other things right now. So
Absolutely.
maybe they still have an intent, but it's gotten to the point, well, you know, that it's like buying the fast pass for Disney and they tell you, well, you're still going to have to wait an hour and a half, right?
Right.
It's like, no, I'm not going to spend that money to not really feel like I'm getting an advantage. So
Yeah,
maybe
what's
that's
the
part of
point
it.
of standing in line if I'm gonna be in line when their production reaches 200,000 units a year?
Right.
There's not gonna be a 2-year wait 2 years from now. So what's the
Right.
point in giving you my money to stand in line?
It's the old commuting analogy. I can, you know, I can leave now and it takes 2 hours,
Yeah.
or I can leave in an hour and it takes 45 minutes. That math doesn't really work out, but it feels that way is the point.
Yeah.
And I think there's a lot of emotion that's tied to a lot of those $1,000 deposits that people have made. So there's that. Here's my thoughts, Travis. You ready for my thoughts?
I'm ready. Let's go.
I see so many investors out there that are looking at the Rivians and the Lucids and some of these other EV companies, and they see Tesla with this multiple hundreds of millions of dollars of market cap and the massive returns that investors have earned owning Tesla. And there's this idea that you're still going to capture that you can capture that same sort of thing with Rivian and with Lucid and again some of the others. And I want to caution people because I think it's one of those things. And Travis, we've talked about it on the show with other things like the solar panel industry. There's
Mhm.
the trend for the industry where there's obvious growth and it's going to be disruptive and it's going to dominate. And then there's how does that how, what is the case for shareholder returns, right? And I'm becoming more and more convinced that is, and as much as these stocks have fallen, they're down sharply, right? They're down sharply from their highs. That these companies aren't necessarily, even at these prices, aren't necessarily going to be market beating investments for people because General Motors and Ford and Tesla and all of the other global automakers have really only over the past year or so made a concerted effort with billions of dollars into building out capacity for electric vehicles. And that's
And
going to take the game back to the economics that it's always been,
and
right?
guess what? They know how to scale. I
Yeah,
think
yeah.
that's the piece that is really hard to quantify if you are interested in a stock like Rivian. They might be the next Tesla, if you will, because they can sort of rethink the business model. They don't have dealers. They can service your vehicle in your driveway. They can do a bunch of things that General Motors can't. But General Motors can say, we're going to make an electric SUV and we're going to make it next year and we're going to make a ton of them and you're going to be done. So that's the balance.
Yeah. I know we're going to get a lot of comments on this video about that, but I just think it's the reality. We've seen the story play out too many times in other industries to think that it's necessarily going to be different. I just want to caution investors on that. So that's Rivian, right?
Yeah. All right. Let me share my screen here.
We're going to talk about Lucid next.
That was Lucid.
Oh, sorry.
Uh, we're gonna talk Rivian next.
Sorry, folks. So yeah, we got a call out from somebody yesterday on the YouTube asking for this one, and we missed it. We didn't see your comment until after. So hopefully you're watching today, and we can help you scratch that itch.
I can't get my screen share up, but I'm gonna go through the numbers here for Rivian based on the numbers that we talked about. So is the backlog growing? 114,000 R1, so that's R1T, the truck, and R1S, the SUV reservation holders as of November 7th. That's up from 98,000 on June 30th. So that is a positive sign that the number of reservation holders is increasing even faster than they can make vehicles.
There you go. There's the slide.
There's the numbers right there. 15,000 vehicles produced, and The big number that you still want to keep an eye on is that $14 billion number. $14 billion in cash. That's down from $15 billion a quarter ago. So they're burning cash at a really rapid rate. So the question is, can they get
that's
to
expected, Travis, because
but
this is where the
that is
company
expected.
is.
That's why we're not valuing this company based on free cash flow, because they're going to be spending a lot of money, both now ramping up production, but then the next step is building out this facility in Georgia, which they said is they still expect to be operational in 2026. We'll see if that is the case, but they're running into some roadblocks there with the agreement that they had with the region and basically the subsidies that were involved. So that could be a little bit delayed. But generally, from a production standpoint, they're still shooting for 25,000 vehicles. They made that prediction early this year, and I think it's generally a positive sign that they're still sticking by that. That they're going to work through any challenges that they had. That would be a run rate of about 10,000 vehicles this quarter. That's a lot of vehicles. So
That's a step in the right direction. And it's
if they
not
can
that long
keep
ago that that's
ramping,
all that Tesla was making too. But
yeah.
the hard part is getting from where they are now to getting to that, and then to 100,000, and then to 1 million a year, right?
Right, and they're going to need to expand their capacity, but 25,000 a year. Well, let's take the 10,000 per quarter run rate is about 40,000 units per year on an annualized basis. Their current facility can make about 150,000. I think they said 200,000 with an expansion. So it's conceivable that they could get to that kind of run rate maybe late next year into sometime into 2024. That would be, I think, pretty impressive. Now you've got to build that Georgia facility and build your whatever the R2 package is. I think that's going to be maybe even more challenging than building the first one. The other thing that they talked a fair amount about was the delivery truck, the EDV that they're delivering. They still have a 100,000 unit order from Amazon, but there has been news that they are now selling those to other third parties. So I think everybody thought that was an exclusive deal for a period of time. Maybe it was, maybe the terms were changed a little bit, but we're starting to see those in the wild. That's one of those things where they can build a platform that I don't know that anybody else can, because they can start from scratch and they can build in all the tools. I mean, when you're a brand new manufacturer and you're working with, is it the biggest retailer in the world now? If it's not, it's close. You can see exactly what does a company that runs at that kind of scale need and build for that, and then start to offer some of those services. And that's what they're doing is they would have service software as a service with these electric delivery trucks to smaller delivery companies. So that's potentially a really interesting business for them, and something that they're maybe not going to have a ton of competitors in. I mean, if you've seen UPS trucks around, they're still the same trucks that were made 40 years ago. So there hasn't been a lot of innovation in that space in a long time. This is a company.
You know what the innovation's been in those vehicles? In the fuel sources, going to lower carbon fuels, looking to electric vehicles, that sort of thing. But like the actual operation, you're right. I want to caution people, Travis, again, because you look at the market value for Rivian stock, and it's clear investors are pricing in that as part of its future. It barely exists right now, and it's not anything that's making the company a material amount of revenue or cash flow. So
are you talking about the electric delivery vehicles?
Yeah. So I mean, in terms of you just be careful about valuing those sorts of things too much is the point. Travis, we want to take a look at cash flows, cash burns real quickly.
Let's look at it.
I got it right here. I'll pull it up for us. So operating cash burn was about $1.4 billion. That's double where it was a year ago. Again, not unexpected, because again, using Tesla is kind of the test case. I know I said it's not going to be the next Tesla, and then I'm telling you to use Tesla, but there's an operational cadence that we can use that's helpful. And part of that is it spends the CapEx and expands a facility, and then adds operating expense as it's building inventory and it's bringing it online before it's generating cash flow from selling the vehicles, right? So this is not unexpected that this has happened, right? We're also seeing CapEx actually came down, but again, we're continuing to see CapEx spend. Free cash flow, I want to talk about this just really quickly, was of course negative, about $1.7 billion. That's accelerated largely because of the increase in operating cash burn. All expected. The key is, if you're going to follow this company, if you're going to invest in it, Travis, just like we've talked about, it's going to continue to burn through cash. We know it has what, $14 billion on its balance sheet, a little bit.
13.8. Yep.
Yeah, 13.8 billion. And it also has a revolving debt instrument that's tied to assets, right? So as it scales up and acquires assets, it'll have access to more and more debt, right? So it has ways to access capital. But the catch right now, Travis, is the balancing act, right? Of careful capital allocation, growing your operations as you're scaling up your ability to make and sell more cars.
So let's go through some of the things that we talked about early on. What are we looking for? The number of reservations is growing and growing more quickly than they can make vehicles. I think that's a great sign.
Yeah, yeah. As opposed to Lucid, where we're seeing deterioration in that metric.
Absolutely. The question is, and we'll see if they talk about it on the conference call, which I don't believe is, I think it starts in just a little bit. We don't know what production expectations look like next year. We talked about the fourth quarter. They're going to do about 10,000 vehicles this quarter. You would expect that to continue ramping up. But I like to sometimes just kind of do some back of the envelope math and go, okay, if you're making 25,000 vehicles a year and you sell them for $80,000, here's what revenue looks like. Here's what your operating costs look like. What do you have to get to kind of pencil out cash flow break even on an operating basis? And when we get that guidance and sort of figure out what the ramp is going to look like next year, hopefully we'll start to get a better feel for that, because clearly the market is not in the mood to fund companies like this in perpetuity.
Yeah.
On the, in the reality is they were in that mood when Tesla was in this same phase. You remember Tesla went back to the market over and over and over again, raising capital, and it wasn't a problem. If Rivian comes out today and says, hey, we need to raise $10 billion, it's not going to happen.
No, that's a third of its market cap. It would be a challenge right now at this scale. The market needs to see scale, needs to see scaling up, selling vehicles, continued demand for more plants like the Georgia plant, right? And if the market sees that and sees good economic activity, then getting $10 billion, the conversation changes. But as the business exists today, yeah, it's not going to happen.
All right, my final thoughts on Rivian and Lucid. Lucid, I think that was a pretty bad report, even just on a surface level. You just don't want to see reservations going in the wrong direction. Rivian, I think, seems to be going in the right direction. I'm interested to dig in this a little bit more and see what the challenges are for the company, because, are we clear sailing on them continuing to scale the business in 2023 and into 2024? I'll put my emotions aside as a reservation holder and getting pushed back there. And just, I'm not a shareholder at this point, but I am intrigued by Rivian, because I do think the disruption in the auto space is these business model disruptions. It's not that they're making an electric vehicle that General Motors can't make.
Right.
They can make the same vehicle, but they don't have dealers. They don't have that segment of the market, of the business, to deal with. They can rethink servicing vehicles. They can rethink what our software looks like. They can rethink of things that General Motors just structurally as a business can't redefine. And that could lead to fundamentally higher margins long term. That's why Tesla has better margins than traditional automakers today. We'll see if that continues, but that's why I think this is an intriguing company. If I think that the risk reward is there and we get past this kind of can they survive point, then it's much more intriguing to me.
And we're getting closer. My final thought is just agreeing with everything you said, plus one addendum. We've seen Tesla also be able to hold those margins, not just because of the difference in its business model, which is meaningful, but also because it really hasn't dealt with any competition.
Mm-hmm.
That aspect is going to change. Now, at the same time, costs are coming down for things like batteries. It's going to help absorb some of that competition too. But 3 or 4 years from now, when you're seeing the largest automakers have meaningful, real high volume EV products and they're competing more on price, that's when we're really going to find out the kind of margins that these pure EV startups today that are just pure EV companies with a differentiated business model. Then we're going to find out what's the difference in the margins they can get and the difference in their operating leverage versus the traditional Fords, GMs, and Hondas. So for now, I'm a really interested observer. But I think you're right. They could be compelling, but we need to learn a little bit more.
Yeah, absolutely. Love to hear your thoughts though. Leave those in the comments section below. And, Jason and I will try to get to those and, answer as much as we can. But there's a lot of unknowns for both of these companies, both Lucid and Rivian. All right.
You want to do a lightning round on Wynn?
Let's do a lightning round on Wynn. I'm going to give just the highlight numbers here. Operating revenue, $889.7 million. That was down $104.9 million. Now, this isn't a huge shock but if you remember, over half of the revenue used to come from Macau. This was the gaming market that's about 6 times the size of Las Vegas pre-pandemic. The problem with Macau is it is a special administrative region of China. And when China goes on lockdown and doesn't allow travel, which they have been doing for almost 3 years now, it's Macau that takes a massive, massive hit. So there have been kind of fits and starts in Macau, but I believe they said that their casinos in Macau were shut down for a 12-day period in July. So they're really coming off of some basically zero revenue days in that side of the business. So let's focus on Las Vegas. Las Vegas revenues $544.4 million in the quarter, up $68.4 million. EBITDA, which is a proxy for cash flow, earnings before interest, taxes, depreciation, and amortization, $195.8 million. I used to use a $500 million annualized adjusted EBITDA number as my proxy of like how much money Wynn Resorts, the Wynn Las Vegas is making. This number right here is $800 million.
That's
so $300
right,
million more than I sort of thought was really good.
Well, I can tell we were in Las Vegas not too long ago. You took me on a tour of the Wynn, and it was packed. It's busy. Vegas is cranking right now. As important as Macau is for the long-term story, Vegas is doing some pretty heavy lifting right now.
That's absolutely true. And the other one that's surprising to me, partly because we didn't know what this property was going to look like when it was built, is Encore Boston Harbor. Revenue $211.8 million. So Las Vegas, gaming capital in the US, $544 million, a much, much smaller property in just outside of Boston proper.
Come see me, we'll go visit it.
Yeah, we should do that. $211.8 million, adjusted EBITDA of $61.1 million compared to $64.6 million a year ago. That's pretty good. And we're not talking about, there's kind of the gaming win, WIN numbers where luck either plays in your favor or against you in certain quarters. So we're just kind of leaving that out of these numbers. But that's a really good property. The problem was in Macau, Wynn Palace, which should be their flagship. We should be doing over $1 billion in revenue a quarter. $75.2 million in revenue in the third quarter. Adjusted EBITDA was a loss of $21.8 million. Wynn Macau, net $40.4 million, a decrease of $90.3 million, and adjusted EBITDA of negative $43.8 million. So Macau is basically a zero at this point. The way that I'm looking at this business, and I'll leave you to the final thoughts if you have any, is Macau is like a massive call option for this company and the few companies that have operations there. If it comes back in any meaningful way, if what happened in Las Vegas, where people were on lockdown for 6 months and then they went absolutely insane in Las Vegas for the next 3 years, what's going to happen when 1 billion people go from zero COVID to being able to go out to Macau? It could be crazy. It could also, the Chinese government could also just shut it down. So I don't know what's going to happen, but it's pure upside to me at this point if Macau ever recovers.
Do you want to? We have time to. I think we promised the people Unity.
Let's give a quick overview.
Okay. All right. So I've got the Unity results right here. I'm going to pull up. They have not released their presentation yet. They've just released the press releases out. So I'm going to highlight some key.
And we should say they completed their merger with Iron Source.
Yep.
On Monday.
Yep. So that's good. Here's one thing that I think is really important. I'm trying to find the line. The results came in within the company's guidance. Okay, here it is. for revenue and operating income, right? And I think that's really important. You know, you see a lot about Wall Street analyst estimates, right? Beat, miss, all that, and that's against Wall Street. I think it's really important to see a company against its own guidance, and the company came in within its own guidance. I think that's really important. So revenue was up 13% for the full year. I'm going to blow this up a little bit. So again, revenue was up 13% for the full year. Now there's some things going on, Travis, and you can kind of help break this down. So Create Solutions, which is the tools that game builders use to make their games, up 54%. That's a real positive. Strategic partnerships and other revenue was up 28%. Good. Operate. This is important because this is kind of like their SaaS piece for generating like ad revenue and for freemium models for selling, right? So this was down 7%, right? So that's a product of the macroeconomic environment and the ad market. Am I saying that the right way?
Yeah, I think that's right. And this has always been the question is, can they build this kind of a model into their business? In theory, it would make sense for them to be a company that kind of helps game developers monetize their business. But this is the reason that they're merging with Iron Source as well. So it's also one of those where I don't want to read too much into this because it's going to take a few years to figure out whether adding Iron Source really fundamentally changes what they can do with that ad side of the business.
So a couple more things. I'm gonna share this again that I want to highlight, and then we can give our thoughts. So again, the business model here is it's the platform that game creators use to build and manage their games, manage the revenues from the games. They had almost 1,100 customers that each generated 100,000 of revenue or more. So there's a little bit of kind of the Roblox model here, but that number continues to grow, right? That's really important. And dollar-based net expansion rate. You have to be careful with these metrics, but the way they want you to see this is for every dollar they got from a customer a year ago, they're getting $1.11 this year, right? So that's how they want you to think about that. Here's the big one. This is a business that has largely generated positive operating cash. Year over year generated 44 million in operating cash. It burned 69 million in operating cash in the quarter, and free cash flow, because CapEx added on top of that operating cash burn, about $81 million. So they're starting to burn through a little bit of cash. Super duper strong balance sheet, $1.3 billion in cash. That number has grown. The business generally, I think, is relatively healthy. The balance sheet is healthy. This is another one of the SaaS high growth tech stocks that has been pummeled by the market from probably an overly exuberant valuation a year ago. Travis, what are your last thoughts on it? And I'll give you the last word.
Yeah, this is one that I own shares. I think I got a little bit ahead of myself with this, like a lot of investors did. I'm a little bit worried about the fact that we're going from generating cash to losses. So, that's not a good sign. I want to see what they can do with Iron Source. But the other worry that I have is as I, explore this metaverse space, a lot of people are building with Unreal Engine 5. That worries me. The people that are building the next generation stuff are not using Unity. So that's a real question mark. All right. Well, thank you, Jason. Where can people find you on the internet?
You can find me all over the place. If you're looking for me on Twitter, find me at The Smattering. And from there, you can find a link to my podcast I do with Jeff Santoro, who's on vacation this week. It's The Smattering Podcast, wherever you find podcasts. I have a YouTube channel too. Go to my Twitter, and you can get my YouTube channel from there. Travis, this was a lot of fun.
Absolutely. And you can find me on Twitter at Travis Hoium, Hoium, and then on YouTube at RIIV, at RIVN. So we will do this again as more interesting earnings pop up. I think we won't be here tomorrow, but this has been a lot of fun. And so let us know what your thoughts are. Leave comments below. And of course, follow both of us on YouTube, Twitter, and we'll share a lot more thoughts there. Thanks. Have a great day, everyone.